Welcome to the DevReady Podcast. On today's episode of the DevReady Podcast, I have Alex Samson with me. Thanks, Alex.
Hi, Anthony. Thanks for inviting me.
It's a pleasure to have you on. I'll let you introduce yourself so I don't make any mistakes and stuff like that.
With pleasure. So I'm Alex Samson. I'm a tech entrepreneur doing this stuff for 24 years, starting from the school. I made 3 exits and running the software business for 14 years, and after the recent exit I decided to jump on VC side. So here I am, already 1 year in this journey, and I would like to share my finding experience, wins and losses as well.
It's exciting. You don't hear about many, I haven't heard of many that make that transition. Sales are hard to get by, and then to actually go into that space, a lot of them jump into the next startup rather than make the transition to VC. But I guess that may be depending on the size of the exit you have.
It's kind of the dream was always I made a great exit, say at least $10 million, so I have capital and I'm launching a VC firm. But the reality that if you're a VC manager, you don't need 10 million capital, you just need to commit 1% of your capital, and you need to acquire capital. So you also need to do fundraising from different kind of investors. To pool the capital and then invest and deploy them into the startups. So that's the idea. But the tricky thing that when you are fundraising for a startup, you're covering all costs, operations, all the stuff, and when you're fundraising to the fund, mostly you need to have own capital to cover initial years of the starting of launching the VC firm, because your operation is covering by 2% management fee, and it's not enough if you have a capital like $5 or $10 million. Initially I started from calculating the numbers, and I can say the minimum sustainable fund size is $30 million, but it's quite impossible to raise 30 millions if you never tried it before and you're just new in the game.
Yeah, starting a fund is quite different than being a VC.
Yeah.
You need to have that, like you said, that ability to raise funds from other VCs, build up yours. It's not all your capital, but you have to have the runs on the board and the track record as well.
Yeah, you need to track record in investing, because a track record as an entrepreneur is great. It's very valuable. It's very interesting, because if you take a look on team composition of different VC firms, you can see guys from financial world, some ex-entrepreneurs, corporates, very, very different backgrounds and cultures, and all these backgrounds make sense. So with any backgrounds, you can come to the game, but also you need some investing experience. And usually, I can say that there are only 2 ways to have this traction. Is go to work in some VC firm as employee for at least, 5 years, 3, 5, 10 years, or have some capital to start investing as an angel, or being like angel syndicate, angel group, like this.
And that's probably where you see a lot of the other startups that have had sales and exits before. If they move into the space, if they get a decent enough exit, they may move into that angel investing or seed, so then they can just invest into other startups. But pivoting to a fund is very different.
The traction as angel investment makes sense. But fund operations is I can say it's next level of complexity, because when you're angel, you manage your own capital. Then you are fund, you need to fundraise, and fundraise is very difficult, because you need to fundraise big checks, working with family offices, high net worth individuals, and some institutions later stages. Then you are fundraising for the fund. You are selling some strategy, some idea, your background. And for me, the hardest thing at the moment is to define the strategy, because when I finding something interesting, I see complexity again. For example, I'm living life like a digital nomad, so working internationally and globally for 10 years, and I'm in a position that I can choose the location, the geography of investing, and always it's great if you have a geography focus. So being global, it's quite hard to be global, even in early stages. But if you're choosing a location, should invest in ecosystems of scientific tech backgrounds with good tech universities, like it can be in Australia, New Zealand, Singapore, if it's speaking about other big region, or should invest in, for example, in Indonesia, because Indonesia has a great market. It's growing super fast, but it's a different type of investing. First, you need to invest in technology. You need to invest in like very tech savvy guys. And in a case with a big market, you need to invest in those who can sell, who can do marketing well, who can execute a go-to-market strategy in their home country, big country. And okay, so this is the first thing you need to choose. And the next thing is the industry. And like AI is hyping recent years, so that's already you can't declare that I'm investing in AI. It's the same like I'm investing in internet or I'm investing in computer science. So it's very, very, very broad. So if you're investing in AI, you need to define what kind of AI. Is it AI for Industry 4.0, or is it B2C AI, consumer apps, something like that? And I can say that most of startups they by default have some AI. AI can be the engine, the core of the startup, or it can be like assistant supplementally to the startup. But yeah, everyone already have AI in under the hood.
Yeah, there's a lot of chatbots that don't need to be
Yeah.
there. Though. Yeah, everyone gets on that bandwagon. So it is important, like I think we mentioned, that having that strategy and that approach. So if, as a VC fund, you then have to have a strategy that's going to attract the right investors that go along with yours. And how will you differentiate from another VC fund? And then how's your strategy going to give me more return? Which is probably an analog to a startup trying to find product market fit for their product. It's what's the right messaging, what's the right approach, how am I going to get my customers effectively using what I'm providing.
Yeah, absolutely right.
How have you found that the learnings that you had over those 14 years with the engineering firm and the consultancy, and then helping you inform your decision or your strategy as moving to the VC fund world?
And coming to this industry with entrepreneurial mindset, for example, I started looking at the VC firm as a product with unit economy. So I need to understand the cost of investor acquisition, the cost of building a deal flow startups, and what team I need, what team capacity do I need to handle all this stuff, how to make due diligence. And by the end, I need to understand the economy per action, per investment action. And this is the thing I'm still working on. As I said, that I found that the capital should be around 30 millions. So it's great if you're able to raise the fund one. I found there's some examples in the world, mostly in the United States, the fund one with 30 or bigger capital. But most of the world raising the first capital, the first fund is like a proof of concept. It can be $3 million, $5 million. So you need to just play in sandbox, trying everything, get the skin in game, and then you can raise the second fund, which can be relatively bigger. So yeah, it's proof of concept, then MVP, and then you are going to the free fly. Yeah, and it's the first thing. And you're absolutely right about the product market fit term. I also found the term is then you're deciding about your strategy is also called the thesis, investment thesis. The combination of industry and the geography can lead you to the empty market. For example, the DNA sequencing cost dropped significantly from $1 million to $1,000, and maybe in the next 5 years, the DNA genome of the human will cost just $100. So this cost open the opportunity for entrepreneurs, for engineers, moving this from scientific world to the real application world, and I see that it can push the software startups in a biotech industry. So I'm start looking biotech in based in around me. So it was Australia, New Zealand, Singapore, Korea, and biotech. I say data startups about for biotech or any software around the biotech, and nothing here, just a few in the Silicon Valley. So the idea is fresh,
Okay.
but it's too fresh to start. So I need to check it again a year after.
So it's the emerging markets are probably different than the mid markets, and then where the leaders are, especially on those ideas. If it's very new, or if there's, it probably depends on the culture of the market more than anything.
So if it's the big existing market, so there are already many VCs, many capital. Usually the capital much more than good startups to invest in, and the competition between investors is too high. So being an emerging investor, you need to find something specific, but not empty. And it's also the challenges of defining your investment strategy.
How have you found that journey of trying to define that strategy? Because as a VC fund, you have to have some rate of returns that you're bringing onto investors, and investing in startups in the entrepreneurial space is not a quick game.
Yeah, this is another challenging in the VC world, mostly in the last few years when we see a decline in many VC metrics. So I start speaking with different, more experienced VC about the fundraising, and the insights can be like, let's take Indonesia or Malaysia. There are many wealthy individuals or conglomerates, corporates which have capital to invest in, but the maturity of technology culture is still developing. So for them, the most easy and most easy to access opportunity to invest in retail estate, for example, to build a mall or something more like private equity. Then you have a cash flow and you can assess the businesses in a traditional way. But when we look in Singapore or Australia investors, they are more willing to make risk investments, like just have a small part of their portfolio they can invest in VC firms. And VC firms, there's established VC firms, so the people from Dubai or Asia, they are more willing to invest in top tier VC firms. But top tier VC firms can give you the high returns, and this is well known. That emerging VC pushing more hard because they aliving or the partners more involved in groundwork. So by the end, it can give you more returns. But what about the traction? What about how many years I'm going to be in this game? Because average time to exit is from 5 to 10 years. And some startups, some portfolio companies can exit in 5 years, but some of them you need to take care about for 10 years. And are you those person that can be in this game for next 10, 15 years. It's also the question.
Yeah, and that's 10 years if you're only investing in things in year one. If you keep investing in startups every year, then that just keeps pushing out as well. And you'll have all those different opportunities. I can imagine it's a very difficult thing to try and maintain as a VC fund. You're not doing a yearly return. You have to try and convince them that at some point, every couple of years, there'll be a big exit, at least get some return that makes up for that loss of yearly returns that they would get with a traditional investment.
Yeah, that's correct. Another thing interesting that my experience mostly from the 0 to 1 for early stage, idea stage startups, definitely only on early stage startups like pre-seed, seed, Series A, maybe Series B. And at some point, I ask a question: what about the secondary market? Like, I'm a pre-seed investor, so I give small checks to many startups. So I have super high risks. The most risk can be in the VC world. And after some product market fit validation, idea validation, team composition validation, and many validations of this team, idea, the market, some of them become good asset. And what's the reason for me to sit in the stake until the exit after the 10 years? Because I can't contribute any experience for late stage companies. It's a real different world for me. So I see logically that I can make an exit as a VC on the secondary market, say after the Series A or on the Series A, and then redeploy this capital again to the pre-seed. So some professionals, some investors will working just in the early stages, others will be working in late stages, and some of will be after an IPO level.
I guess that depends on sort of your risk appetite, and then the type of return you expect. Because if you're in the seed stage, you're going to get a decent return if they get to a Series A from that very early stage investment, and you'll have a larger share when you get to that IPO. It's going to be very small. If it's Series B or C, again, it's going to be a smaller stake, but it's larger numbers. And those ones are probably a lot quicker to cash out. So investment will go in, and it won't take 5-10 years to get the cash out on the next step.
Yeah, but the fact there's no culture for the second market. I haven't found it. It's mostly because the crisis in the industry. So many VCs start selling the assets, the stakes to have some liquidity. So it's great opportunity to buy on the second market. But I would like to see the clear picture, the clear culture of one working in the early stages, others in so one will work on the early stages, and others working on the late stages. And you said right about the stepping from the round, from the stage to the stage. And if people start speaking about the valuation, so the main business is to buy the stake for the small price and sell the stake for the higher price. So it's all about the valuation for VC. And I start looking for business metrics the startups had on exit. For example, the most simplest example is revenue. And for example, the correlation between revenue and exit valuation could be like 3 times, 5 times, sometimes 10 times. It's very depends, but it's not not different. So, for example, we can take 3 or 5 times. And for example, we as a VC, we have a financial model of other operations that we need make exit on 10x. So if we are making an investment in startup with valuation, say $50 million in the Series A, so the exit valuation should be $500 million. So it's very clear math. So the question is, what the revenue the startup has at the moment, and how fast it should grow to reach 100 million revenue to be
That number.
estimated, evaluated as a $500 million startup. And doing this math from the end, from the
Hmm.
exit valuation, you can like reverse engineer this to the pre-seed or seed checks and their correlation with the revenue. And the problem of the startup market that you need not just have a good revenue, but you need to grow very fast, really super fast. You need to grow
Yeah.
faster than the market. But sometimes the startup is going to the market which not growing, like old big market, say agriculture, for example. And in this case, you need to penetrate the market to change the composition of competitors, of technologies there. And there's also the question how fast you can do this.
Those traditional markets become difficult then because they've got an ingrained way of doing things. Maybe they're very slow for technology adoption. So then that could be very enticing in the long term if the sales there, but the growth rate may take longer than you probably expect.
Yeah, exactly. And for VC, it can be means the zombie company, which can be self-sustainable, profitable, but they grow too
Hmm.
slow to have these 10x.
Yeah. So how do you manage that as a VC then, where you've got that formula that you're working on, but not every investment is going to give you a return? So how do you manage that?
There's some statistics like 70-90% will fail. Uh, Again, it's the question what to
Yep.
call fail. In first case, it's bankruptcy. But if it's a zombie startup which have profit but not can grow, it's also fail for VC. So usually we're talking about the 3% of the portfolio which can benefit. And I also made a math
Hmm.
to calculate how many startup you need to assess. You need to have a deal flow to have the probability to find the unicorn and the numbers in the thousands. And it was also the question like, okay, if I
Well,
need to process thousands of startups during the year to make one unicorn investments, what team do
hmm
I need? So it's again the question about okay, I need a team, need a cost need a management fee, so I need a bigger capital, or I need to invest
yep,
in operations for the first years. But
yep.
another side of the question, you need to give it traction. Um, how to find the startup which can benefit, and for me is emerging VC. It's very important to build attraction, like a 5-star A class traction to attract LPs. Then I will ready to
Yep.
launch the fund. Um, so I'm
Hmm.
trying to do roughly market due diligence. Mostly it's market due diligence.
It's an interesting position you're in.
Hmm.
Yeah, you're a startup VC fund.
Yeah.
You're doing the same things, but at a VC level.
Yeah, it's hard to switch off my startup mindset, and yeah, I'm using these techniques. Um, so regarding the due diligence, and also I'm a mentoring. I'm mentoring in a few accelerators and also in private mentoring. And the key things in my own mentor program is the market research and unit economy. And for unit economy, you need data from the market research. So it can be different. And in this point, you can project the numbers which you don't have at the moment, but it's your idea. It's you need to build a model of your business having the customer acquisition cost, which is super high in any industry, and many founders don't realize the real how to hard to acquire users and have a good retention rate. Building this model and then like show me how it will generate $1 million revenue, for example. So how many customer care you need to have, how you're going to onboard users, um, like engineers is engineering R&D is could be like 30% of the expenses, and operations, marketing, sales. This is the most hard part, mostly for founders who came to the game with tech background. And I also have seen in my experience with my previous clients, the usual use case, like the market was validated by the decision of the stakeholder, the main stakeholder, because he's an investor, he has experience in a traditional business, and feeling he understands everything, and okay, let's start building and move forward. And after my team and I spent a few years in such startups, it take you motivation to start new things. Even it's not your things, but you also have some expectations, some dreams, and you would like to be in a part of something successful and big. We are also starting some pre-project validation about will this team able to launch this business, this startup, and if we are responsible for technical side, how they can be responsible for the business side. Again, mostly for the sales, which in a B2B, B2B sometimes at biz dev, so you need to have the team of strong salespersons who are going to conferences like growth hacking, like this, and others is about online marketing, which is very complicated at this moment.
Yes, there's a lot there to consider, especially if you're a technical founder. Then you don't necessarily have those skills. You're more the engineer product side. So then you have the non-technical founders who may know how to do the sales or the biz dev, but don't have any of the technical expertise. So they need that tech partner to help them get started.
Exactly. But if you are engineer, you can switch your engineering mindset to engineer the business, not the technology. And if
you can create another algorithm step by step. You can break things down.
Yeah, definitely. And this is a great case then. Engineering minds start solve business problems.
Yep. They just need the right people skills as well.
Yeah.
Some of them aren't the most social people. So, what are some sort of key takeaways that if there's anyone out there looking to raise at the moment or in the current market, what are some things that they should consider?
Advices for startups. The market is tough at the moment in terms of fundraising. So the problem is coming from the capital holders, which don't invest too much in VC. So which VC funds have less capital to deploy than 2 or 3 years before. So that's why the assessment, the making decision is they made very carefully. But it's still possible to raise. Well, I can say if you just look on the YouTube, there's many bloggers, and some of the bloggers looks very strange, but they still have an audience. And I can say this as an example that any startup, any founder can find own investor. So it's not advice for everyone, but from my perspective, as I said, the most important thing is financial model, its business model, if it's sustainable on big numbers, how you validate it. So in case if you're pre-revenue startup, there's many things how to validate idea. For example, try to reach out to your prospective clients and sell them idea that you are building. If they're ready to spend 1 hour of the call of interview, so they already invest the commit that the probability of the buy your product or your service will be higher. If they will be engaged in some giving you feedback on prototypes or something, it's great commitment. Or you can just place a wish list form or try to launch on a product hunt and get product hunt of the day or the week or something like that. So there's a many ways how to
Yep.
confirm your idea on the wild market, because any friends, any partners who can say that's a great idea, I will going to buy it, it means nothing, because cold market is very wild and
Yep.
um yeah, and always think about the competition that you compete not only with direct competitors, but also with the behavior of the users to solve their problems or their needs the same way they using before you came to the market. And it's a question about how to overcome the innovation resilience. And first, you need to identify
Mm-hmm.
how your users is solving the problem, and then you need to give them something more significant. It just not to be just more useful, like just increasing usability, usually not the real driver for the market. The best momentum is the crisis in the market, because uh, it make changes in beneficiaries of this market. For example, the old industry have key players, and these players trying to control the market and keep the status quo. And then the crisis in the market, there can be some changes, and the businesses and end users are more ready for trying something to bring them back to the stable. But then they are in a stable state. You bring some innovations. Innovations means changes, and changes means the losing of the stable position, which is quite hard. So this also the thing when you are launching the startup, think from this perspective if there is a crisis or how you're going to overcome the innovation resilience. And in this case, it's great if you have direct competitors, because altogether you are educate the market, you are trying to make some shift there.
Yep. So some really important takeaway key points there for someone who's going through the journey to pick that up. Um, so if anyone wants to find out more or reach out to you, Alex, how can they do that? And see if they can get it involved in what you're doing or pitch to you.
The best way is find me on LinkedIn. I'm trying to be very active there. And also, I have a website, swalse.com. So you can find some contacts there, and some of my recent articles and information about there. I'm mentoring in accelerators.
Yep. Oh, perfect. And we'll add those notes into the show notes and put them on socials as well. Once again, thanks for joining me today. It's been a pleasure chatting to you and understanding the journey that you're going through as a startup VC, I'll call it, which is something that I haven't heard too much before.
Yeah, thanks for great questions. And honestly, it's my first podcast interview, and I believe it's a great start. Thanks for this opportunity.
It's been a good chat, and I'm sure you'll do plenty more. Thank you.
Okay, thank you.